These limitations could end up costing you a fortune if you're not careful enough. Watch this video to learn why technical analysis can be very dangerous. In the last video, we talked about the efficient market hypothesis. If you haven't seen it, I recommend it not only because it's really good information to know as an investor, but because it will help you understand concepts in this video. Like everything in life, nothing is perfect. You won't be surprised when I tell you that there are limitations to technical analysis. If you have already watched my video, you know that I like to present both sides of the arguments when talking about advantage and limitation of a technique or theory. In this video, we are going to see why technical analysis might not be the perfect solution. First, it's frequently criticized for focusing solely on price movements while ignoring the company's fundamentals. But as we already saw, people who use technical analysis have the assumption that at any given moment, a stock price reflects every aspect that has or might affect the companies, including fundamental ones. In the same order of ideas, according to some analysts and academic researchers, the efficient market hypothesis proves that historical price and volume data do not contain any actionable information. However, using the same logic, business fundamentals should also not contain any actionable information. Another argument against technical analysis is that since history does not always repeat itself exactly, studying price patterns can be ignored. There is no algorithm that allows you to use the past to predict future movements in the share price with certainty. This is why technical analysis is not perfect, and it's important to be aware of its limitation. Basically, it is still possible that even if all the indicators converge to provide you with buy signals, that the share price could continue to fall. A third criticism of technical analysis is that it works in some cases, but only because it constitutes a self-fulfilling prophecy. For example, many technical traders will place a stop-loss order below the 200-day moving average of a certain company. If a large number of traders have done the same and the stock reaches the price, there will be a large number of sell orders, which will push the stock down, confirming the movement trader anticipated. Then, other traders will see the price decrease and also sell their positions, reinforcing the strength of the trend. These short-term selling pressures can be considered self-fulfilling, but it will have little bearings on where the asset prices will be weeks, months, or years from now. And some, if enough people use the same signal, they could cause the movement foretold by the signal, but over the long run, this sole group of traders cannot drive the price up or down. There is also the possibility of having false signals for a handful of reasons. True technical analysis is based on various mathematical and logical factors. They may give signals which are opposite to the market. While technical analysis may tell you the market may move upwards, the markets can still go downwards and vice versa. For example, a share can have a substantial move already taken place by the time the trend is identified using technical analysis. Since the share has already made a large move, the risk to reward ratio for the individual will be less. You can also have false signals because of your bias. There is no strict methodology that one must adhere to when performing technical analysis. As a result, the analysis will be dependent on the personal bias of the individual. If someone is more of a bullish personality, he will have a bias toward those patterns and signs. In the same order of ideas, since there are different methods of analyzing data in technical analysis, it is always open to interpretation. Two individuals can look at the same charts and see two different patterns, both of which can have logical support and resistance level that justify their positions. As we saw, you need to be very careful when using technical analysis or things could get real ugly real quick. If you want to use technical analysis, I recommend using it as a complementary and not as a standalone technique. As always, like, comment, and subscribe if you want to be a better investor in the future. Have a great day, everybody.